Stay on top of stories about stocks that may impact the market or your portfolio today in Stocks Making News.
Well, when we recently talked about Alibaba, the Chinese e-commerce company, we did say we'd keep an eye on it and maybe follow up with more news later. The only thing is we didn't know it would be this quick. So in more developments regarding that Chinese e-commerce company, Alibaba, now Yahoo says they want to spin off their stake in the company. Will the problems never end for Alibaba? Tracey Ryniec, Dave Bartosiak, and Todd Bunton as an added bonus. All join in this conversation. And boy, it is getting more interesting as the weeks go by, isn't it?
It is.
Tracey, there's a little bit of a glitch here, though, it seems, for the Yahoo shareholders, because current rules on taxing spin-offs preclude the IRS from denying tax-free status of the transaction, right, from giving it tax-free status. So they're going to deny that. According to the latest reports. So what that means is this could be a taxable event for Yahoo shareholders, right?
Well, it could be, or maybe not. Nobody seems to know, and the IRS is kind of hedging its bets. It doesn't want to really allow them to do it tax-free, but it's not sure it can deny it either.
Oh.
They have a really big ruling from a well-regarded law firm, Skadden Arps, that says that they should be able to do it tax-free, but whether or not that'll hold weight with the IRS, no one knows. But to me, the whole thing about them deciding to go forward with it anyways, even though they didn't get an actual ruling from the IRS, means that, you know, something else is going on there, that Yahoo just really wants to dump these shares now. They want to get this over with, they want to move on, and I think that's a good thing, because really they need to start focusing on their core business. The core of the business, well, it's been improving under Melissa Myers. It's not like as great as everybody expected when she took over. Obviously, it was a sinking ship when she got in there about 3 years ago, and so for anyone, it would be hard to turn around. They've made some strides in some areas, like social and mobile. The revenues are up 60% in those areas year over year, but their costs of getting those revenues are also up. So really, overall, the revenues are kind of flat in the core business, and that's not what anybody wants to see, especially in tech land.
Right.
Flat is not good.
So as we sit here on September 30th and talk about this, what exactly is the core business of Yahoo these days?
Well, a lot of it is search still and advertising. And right now, advertising is good, even though they have a lot of competition in that area. But advertising is also really heavily dependent on the economy. In a good economy, it's booming, but it's also the first area that starts to fall in a declining economy. It's the first thing you cut is advertising. So, hopefully we avoid a recession for quite some time, but eventually, given the business cycles, it will slow. And then what will happen to Yahoo?
And do you think Yahoo made this determination to benefit their shareholders, to strengthen their company?
Well, I mean, I can't speak for them, but
if you had to guess?
Well, I mean, it's a distraction now, I believe, and they want to move on from this. And their shareholders have been clamoring for it for a while. I mean, it's just a huge transaction here for them. And so, yeah, they want to benefit the shareholders, they want to move on, and they want to focus on the core.
All right, let's bring Todd Bunton in here. Todd, as I understand it through published reports, the value of the Yahoo stake has been cut in half this year as China's economy slows. We're talking about a 15% stake here, which according to published reports is worth nearly as much as Yahoo itself. You've got the numbers behind the spinoff.
Yeah, that's right, Terry. So I did sort of a sum of the parts valuation here on Yahoo. Basically with two scenarios. The first one being, let's assume that the spinoff is not taxed. So Yahoo, spins it off in Q4. The IRS says it's fine. Let's see what you're getting as a Yahoo shareholder. Based on today's market price, you're getting about $24 a share in Alibaba. They also have about a 36% ownership interest in Yahoo Japan, which is a separate publicly traded company. I assume that's fully taxed at a marginal tax rate of 40%. You're getting almost $5 per share in that. And then Yahoo has a very solid balance sheet. They have almost $7 billion in cash and equivalents on their balance sheet, about $1.2 billion in debt. So if you net that, and again, this is conservative, I assume, let's say that cash is overseas and they have to repatriate it and pay the 40% tax rate, you're getting $3.71 a share in that. Total market value there is almost $33 a share. Well, you can pull up Yahoo's ticker symbol. It's trading below $29 a share right now. So based on this scenario, the value of Yahoo's core business is negative $4 a share. And if you look, Yahoo generated about $1.29 in adjusted EBITDA over the last 12 months, generated over $500 million in free cash flow over the last 12 months. So there's obviously some value there. Now, as to what multiple you would apply to that's definitely open for debate. But based on these numbers, Yahoo looks very attractive. Now, scenario 2, let's assume Alibaba gets fully taxed. This seems to be the scenario that the market is pricing in, because that takes you down to about $14.50 a share for the Alibaba stake. You add everything else up, you're getting about $23 in total value there. Again, Yahoo's trading just under 29, so you're paying about $5.50 a share for Yahoo's core business. That's about 4.3 times multiple on EBITDA. Still a very low multiple. That's about half of what the S&P 500 is trading at. So in either scenario, it seems like the market is not assigning much value to Yahoo's core business, especially in that first scenario, which it is still a possibility, right? So I see it as kind of a heads I win, tails I don't lose much scenario. It's a reason why I'm a Yahoo shareholder and short Alibaba, to kind of carve out the stub, carve out the value here. I think once that spin happens, then the market could realize the value here.
Not something necessarily, Todd, to say Yahoo about, though, right? If you pardon the pun.
Right.
Dave, I know you like those puns. So
well, you'd have to be a Yahoo to own this stock. No, I'm just kidding. Just kidding.
Let's talk more numbers. Shares of Yahoo have fallen about 45. I'm just going to totally gloss over that. Shares of
Todd's
Yahoo
gonna beat me in the hallway.
Shares of Yahoo have fallen about 45% this year so far,
right,
as the company struggles to revive its core online advertising business, among other things. What's this picture look like?
It's ugly. I mean, it was almost like a proxy for Alibaba there for a while. So you have all the risk of Alibaba plus all the risk of Yahoo. So that's a lot of risk, and you're not getting too much. So from the valuation standpoint, obviously Todd's hit it on the head. But if this market is pricing in the spinoff being taxed, it's also pricing in Yahoo not doing anything over the course of the next year or so. Mm-hmm. So we're sitting at like $28 a share right now. We were up at 52 when Alibaba was doing well, and it's a falling knife right now. Really, it's broken through any support level you could possibly imagine. And now we're looking at the 2013 prices to see where Yahoo is right now. So has Yahoo's business improved any since 2013? I don't know. It used to be like Google versus Yahoo way back in the day, right?
Right.
And now it's, Google's head and shoulders above Yahoo, and you're wondering, where's Yahoo going to make their next buck? The stock chart, I would avoid it. If you gave me $4, I wouldn't buy Yahoo right here.
But to completely say the core is worthless isn't right either. So maybe it is a buying opportunity.
Maybe, obviously the core is not worthless,
right?
I'm throwing the baby out with the bathwater
yeah.
there, talking a lot of garbage. But the risk that you have to take on in order to hope that Yahoo starts to turn around and we do start to value that core business might be too much here.
Okay. So you just don't like it.
It's just a falling knife. It's like, especially the way that this market has been, it's like the bad news gets punished and the good news gets ignored even, right? So you've got two major risks here in the stock. You still have an Alibaba risk and you've got a Yahoo risk. So anytime there's any news that's negative in any way, shape, or form, Yahoo is going to take the hit. And that's what's been happening over the course of the last 3 months. So I would try to find strength, especially in a market like this, rather than trying to grab this falling knife.
I really wish we could draw you out of your shell more so you could tell us exactly how you feel.
And I was totally joking about the you got to be a Yahoo thing. Not a dig. That was too harsh. I didn't mean it like that. It's okay. By the way, I love the IRS, like you were saying before. Hi, guys. You're the best.
All right. Thanks, Tracy and Dave. And we thank Todd Bunton for jumping in here with some added bonus material as well. We're going to keep an eye on this, as we said last time we talked about Alibaba, see how this whole situation develops from here. In the meantime, if you're watching our videos on the YouTube platform, by all means, you can subscribe to these videos and even comment on them. We welcome the feedback. With everyone here, I'm Terry Ruffalo.